Hey, everybody. Thank you so much for joining us this late evening podcast, Beat the Odds at Business and Wealth podcast. I'm Trevor, and I'm here also with Josh Spurrell, who is in Anaheim, California. Hey, Josh, how's it going today?
Oh, pretty good. It's been a busy couple days. I've been presenting at the Thrive Time conference here with Clay Clark and Eric Trump. So it was an interesting conference. It's always nice to see what's happening south of the border and gauge their temperature. But we got some big news happening locally. So I was reading the headlines. The bond market blew up. Right? That's what we're being told. The bond market blew up. So that's what we're going to talk about today.
Yeah, no, that's good. So, what's the weather like in California?
I mean, it's nicer than there in Edmonton. It's
I
nicer
tell
than
you.
Edmonton for sure. Yeah, it is. Although it's been pretty early days. I've been, this conference is a long conference, so I get there when it's dark and I leave when it's dark. So long days, but yeah, it was interesting. This is my first conference down here. The last conference I was down here was kind of right after the Charlie Kirk shooting. So the security was, the Secret Service was kind of off the chart last time. This time it was still there. You can see that they still have extra precautions. They put like a skirting in front of Eric this time where it was like a bulletproof like a bulletproof kind of material that if he decked, nothing could shoot at it. But I feel like the temperature was a little lower, right? Like it was like a little lower, people were a little more calm about it. It seemed like people were really on edge last time because it was so fresh, basically last time. But good to see because I mean, last time I was doing a conference uh, you know, deep in the heart of Trump territory, and this time I'm in California, so a little bit of a different viewpoint out here. So.
Yeah, for sure. So let's talk about the bond market. Let's talk about the headlines today. What's going on with the bond market? What's the cause? What's the effect? Why is this happening right now?
Yeah, let's pull it up. Let's show people what we're talking about here. So I'm just gonna go share my screen with you here, Trevor. I'm gonna show people the chart that we're talking about because this was the headlines that maybe some of you are reading or you're gonna read in the next day or two, and it's saying the bond market blew up, right? But I just want to show you this right now. I'm going to show it from a 3 month perspective here. So what we're seeing is, if you can see, 2.953. This is the Canada 5-year government bond, up by, let's call it 19 basis points, but let's call it let's just call it 20 basis points. So it's a pretty big move in one day. 7-8% move in one day. That 0.193% is the yield. Okay. And the headline was it blew up. Okay. I- I'm going to give, I always tell people like when in doubt, zoom out. When in doubt, zoom out. But and I'll do that in a second. But like, what's the main headline that's telling people why this happened? And I'm going to give people a secondary headline that they might not actually be thinking about or reading. Okay. But the main headline about why this happened is you saw this spike up here. You saw the unemployment rate come down to 6.5%, and effectively that coming down to 6.5% dropped the odds of a rate cut from 75% to 50%. Okay, and that's what we're saying is like, okay, if rates are going to be short-term rates are going to be lower, that also long-term bond rates will be lower too. And of course, the 5-year Canada government bond is important because it's kind of the basis for fixed rate mortgage project products in Canada, where we have 5-year fixed rate mortgages. So a lot of people are getting fixed rate mortgages. This bond rate is more important than the overnight rate for people who are on variable rate mortgages. Okay. But I'm going to zoom out a little bit here and give people a bit of perspective. That's what we actually saw today. Okay. So when you zoom in on a 3 month basis, you're going to see some of these scary looking charts here. And here's a 1 month chart where it just looks like bang, it's taking off to the races. And even 3 months probably looks a little bit intimidating. And then you look at 6 months, all of a sudden doesn't look so bad anymore. Okay. So that's a bit of the perspective that people are talking about. So Trevor, how much noise did you hear on your side today from the bond yields? Is there anything coming across the wires from the Dominion group there on um, fixed rate mortgages today?
There was a bulletin that came out, and I was so busy today I didn't get a chance to read what it said. But yeah, Sherry Cooper
Yeah.
had a bulletin that came out talking about the job market and the bond market and so forth. But I get a chance to read it. So my question is like, what is it like? Our dollar is taking a hit right now. So how does that weave into all of this stuff with the price of bonds, and interest rates, as well as what happens with our dividend paying stocks?
I mean, it's, the lower rates are, the higher asset prices are in the long run. The system's set up to move the money from the people who do the work to the people who borrow money smartly to invest. So the cheaper they can get access to that capital, the higher that those asset prices go. But I mean, it was a pretty small move in the scheme of things. Has there been a weakness in the dollar? Yeah, there was weakness, and the lower an interest rate is, technically the weaker the dollar is going to be too. You're also just looking at a bit of a range too, because there's the generally speaking, you're only going to see the 5-year rate on the Canadian side and the U.S. side move within a particular band too. So you get a bit of that where they kind of move together. And I think a lot was made of, first I checked if there was any sort of new bond issuance on today. That's to say, like we were actually having a marketability problem on the bond, like maybe they did a new bond issuance today, but it wasn't that. It was simply the labor market news, which I think is the first part of it, and I think that's going to get a lot of the headlines. But I'd like to draw people's attention to the second headline, or the second reason that I don't think is getting enough attention, is the fact that the Japanese bond market really is blowing up. And if I was to show you a chart of the Japanese bond market, you would actually see a real acceleration where, Japanese bond markets are at, 20, 30, 40 year highs, depending on the length of duration of the bond. And so what happens is that begins to unwind what we call the carry trade. And so historically, Japanese investors have been able to, or global investors have been able to borrow money cheaply in Japan and then buy other international assets. And people talk, a lot about them buying, U.S. treasuries or U.S. stocks, but they also buy Canadian stocks and Canadian bonds at the same time. It's a, relatively stable currency. And so you're seeing that, putting downward pressure on all asset prices now. And people often forget, Japan is the third largest economy on planet Earth. And so when all of that capital gets pulled back, because we know those investors can no longer borrow at, zero or next to zero in Japan and invest overseas, all of a sudden they're paying real interest rates. So they have to call that capital back to avoid being margin called. And that's putting downward pressure on everything. And you're seeing that. I think you see that in Bitcoin. You've seen the volatility in the U.S. stock market, especially the high flying tech stocks. You've seen the pressure on the U.S. bond market, and now you're seeing the pressure on the Canadian bond market. And I think that's probably happening to a greater degree than people think. And I think a lot of it's going to be made about the unemployment rate. And I think that was a real kind of needle mover. I don't think people should ignore that, but I don't think enough is being made at liquidity is being sucked out of the international system and called back to Japan.
Right. Yeah, I was just looking at the report from Dr. Sherry Cooper, and yes, it talked about the jobs, and really let's discuss that a bit. The jobs weren't like major full-time jobs; it was mostly part-time jobs. But at the same time, it really helped. The decline in the employment also made sure that the Canadian dollar is going up, and the interest rates are also probably going to go up, or at least stay the same. We're not going to have a decrease like we were thinking we're going to have in the interest rate. So.
Yeah, stay the same. I think the market is still predicting 50-50 at this point. So before it was 75% cut, 25% no movement. I don't think there's a high probability of an increase at all. I think it's more 50-50 cut versus stay the same. But I don't think I think everyone is really ignoring from a large part the carry trade and the downward pressure on all international assets, Canadian bonds and Canadian stocks included. That is a real thing, and it'll continue to put downward pressure on the market. And and that's just what Japan has to do, because if they don't raise rates, if they don't keep if they don't keep their rates sufficiently high, all of a sudden uh, their currency could get inflated away, and that's a big problem for an energy importing nation. They won't have they will, it'll be harder and harder for them to import the things that they need. So ultimately, they have to keep their rates, where they are, because the U.S. have kept their rates as high as they have for as long as they've had. So I think this is a bit of the fallout from as Trump likes to call him too slow Jerome, or whatever, from keeping the rates as high as they have in the U.S. for as long as they have, right? Whether you agree with it or not, that this is kind of the likely conclusion of it, right? And so I'm not sure we're going to see a lot of movement on that unless we see U.S. Rates in the U.S. starts to fall, which will take the pressure off the Japanese market, which will take the pressure off the Japanese investors unwinding their carry trade.
So in the meantime, like, what does that mean for investors in Canada? Like, what do we do right now with this information? Because obviously this isn't going to be like a long-term, struggle session. Like, how long do you think this is going to last? And what should our viewers be doing right now as their investment strategy?
Not, it's a good question, Trevor. Not panicking, not panicking. So remember, when I zoom out on that yield chart, that's not a big deal at all, right? When you zoom out when you look at the 3 month chart, it looks pretty scary. As soon as you look at a 6 month chart or a 1 year chart, it no longer looks that scary. So I think what you need to do is maybe, uh, put a little less credence on, is the Canadian bond market blowing up? It's like the Canadian bond market went up by 20 basis points today. That's not blowing up. And in this day and age, with as much debt and stress in the system, we should expect this volatility, right? And I think that's going to be, some of our topics as we move forward here is I would be expecting more than normal volatility for 2026, because basically just a lack of liquidity in the system. And so people are going to see more volatility, and the kind of the market's designed to move the money from the impatient people to the patient people. And I think there'll be a lot of movement this year that will tempt the paper hands to part ways with their investments. And so is it, a little bit concerning when it goes up? Yeah, it is, but this should be expected at this point. We have nations around the world where their debt to GDP is increasing to historic rates, and ultimately that's going to put volatility and downward pressure on some assets. But ultimately, what's the counterplay, is to move money out of assets into currency that we know is going to be devalued. Like, we just don't know the timeline, and that's going to create the volatility. And so the temptation will be, say, okay, well, I see this is a stress factor. I'm going to take the money out of the market, and I'm going to put it into cash or short-term money markets. But the problem with that is the release valve is the currency. There's only two release valves, and that's balancing the budget, or that's devaluing the currency. And pretty much we would expect all of the Western governments to do the same thing, is to devalue the currency, because people like to vote for so-called free stuff, which they don't know is just funded by printing new money and basically devaluing the existing currency.
Yeah, I was just going to ask that. Like, how is this going to be affecting the money supply, the M2 money supply worldwide, as well as United States and Canada?
Yeah, I mean, ultimately, the money printer's heating up. we know the U.S. banking system is largely running on fumes right now. And I think we're going to, probably put that as a large focus on what to expect in 2026. And so it is largely running on fumes, but how they, you know, uh, re-liquidate that, re-inject capital into that system, how fast they inject capital into that system, and how fast that takes effect in the actual money supply is largely unknown. Like it's largely unknown because they haven't ever done quantitative tightening for this long and this steep before. And so we can speculate, but we have nothing to compare it to because it's just never happened in the last, 53 years or our fiat system. We had a much more gradual quantitative tightening, leading up into 2019. But this was a much steeper quantitative tightening, and we've come to the end. So it was just like, when they injected all the capital during COVID, the inflation was relatively certain, but there was a time delay. They injected a lot of that capital right away in 2020, but people didn't see those inflationary effects until 2021 and 2022 when it kind of peaked. And so it's going to be the same thing this time. Is they're going to put capital back in the system, whether it's this month or sometime in 2026. But even when they put it back in, how long? It's like a time delay fuse before you actually see the increase in the money supply and the appreciation of asset prices.
Yeah, and another thing that we haven't really touched on is the reverse repo market. Like how much do the banks have? Like what can they borrow? Like what is that looking like right now?
Yeah, they don't have a lot right now, and I think we'll probably drill into those charts next week when we'll look at the reverse repo market and the overnight repo market. Effectively, the banks are their savings account has drained, the reverse repo market has drained, and now their repo operations, they're actually in their overdraft account, and we can see that. And the Federal Reserve knows this. This is why they ended quantitative tightening at the end of November. But so far they haven't overtly said quantitative easing, although we expect it collectively because we know the stress that was under the system. We're probably waiting. I've been telling people we're waiting until January when we're actually going to see the reports where we'll see what the use of the overnight facilities are at the end of December when they have to be in compliant assets for their year-end reporting. So right now we don't know, and the injection of right now the kind of the volatility in the bond market, it's actually, in my view, it's actually pretty moderate volatility compared to the stress that's in the system right now. So I would tell people this is largely a nothing burger in the scheme of things. It can be a reason where paper hands would fold, but your only real option is to fold into assets, which are effectively
Mhm.
cash or short-term investments that are near cash. And ultimately, we know, the longer we hold cash or the longer we hold bonds, the risk of inflation is virtually certain.
Yeah, 100%. I mean, we know if we hold on to this paper stuff here, this plastic stuff, it is slowly vaporizing as it sits there on the desk. I do have a couple of questions from the chat. Did you want to address those?
Yeah, yeah. What do you got in the chat there?
All right. So in the chat, we've got so a question for today. If U.S. Treasuries are being sold off, does this mean that Canadian dividend-paying stocks are now more attractive to buy and hold?
If U.S. Treasuries are being sold off, I'm not sure it's, if U.S. Treasuries are being sold off, I mean, it depends who's selling them, right? If U.S. Treasuries are being sold off by the Federal Reserve, it effectively makes all assets lower price because that's sucking the cash out of the system into the Federal Reserve. Okay, they're selling the U.S. Federal Reserve is selling their treasuries, pulling the cash back out of the system, and that puts downward pressure on all assets. But that being said, trying to time those operations where those dividend paying stocks, the other asset, it's everything. It's not just Canadian dividend paying stocks. It's US stocks. It's US tech stocks. It's US dividend paying stocks. It's Canadian growth stocks. It's Canadian dividend paying stocks. It's Bitcoin. It's gold. It's like as that cash gets sucked out of the system, it puts downward price pressure on all of it. But the problem is that we know that there's no political appetite to balance the budget. So our ability to time that is basically, I would say that's speculation. That's not investing. And so, if the U.S. Federal Reserve is selling off, that puts downward pressure on it. But we know that, effectively they were supposed to stop shrinking the balance sheet on November 30th was the announcement.
Okay, thanks, Josh. Now we're getting some love from Stuart Rogers 6464. I've been enjoying the shows and I've learned a lot from you guys. It's nice to see some real Canadian advice and information. Thanks. I've started to look forward to all your shows. Hey, thanks a lot, Stuart. Appreciate it. Let's see here. We've got another question from Sean. Was the latest GDP growth mostly achieved through increasing the money supply, in your opinion?
Yes, yes. You really need to look at the like increasing the money supply and population growth too. So you get a lot of like people who say, look at real GDP, look at real GDP. The problem is like real GDP is nominal GDP divided by a GDP deflator, which to all intents and purposes is a lot like looking at the CPI, that it's a basket of goods that's kind of heavily manipulated by the government. So I tell people like just look at nominal GDP, like start with nominal GDP, because even so-called real GDP divided by the GDP deflator does not take into account increases in population. So how real is it? You know what I mean? If you have population growth of 1% and real GDP growth of 1%, you actually had no GDP growth, right? And so I tell people like look at nominal GDP because it's not it's estimating GDP is hard enough. Taking the estimate of the GDP number that's largely an estimate, and then dividing it by another estimate with a large political motivation to make it seem better than what it is. Like I don't think that's great, but yeah, I see it largely we have seen it's still very moderate, very subdued increase in the M2 money supply in Canada, but more so than in the US. So I would say, yeah, largely the GDP growth in Canada was a factor of both increase in the money supply and population. Although, we haven't had the same population growth as we had a year or two ago, we still have population growth. So both of those two factors.
Nice. Okay, and I've got one more question here from Travis. Travis says, do you ever sell high dividend stocks or sitting on them forever? Also, Josh, when was the last time you topped up on Bitcoin? Bootcamp was life-changing. Thank you.
Yeah, I mean, no, I don't sell dividend stocks. I don't like, and that's my whole thesis is like I don't want to pay capital gains tax. And most people are wondering like, well, how do you not pay capital gains tax? It's like you pay capital gain tax the day you buy something, knowing you have to sell it. Basically, you backed yourself into a corner trying to buy low and sell high. And first of all, you're trying to time the market against market players who I believe have way better information than we have. I believe they're the big investment firms have direct contact and they have direct input into the Federal Reserve. I mean that's not my belief, that really is the system. So we're not playing with the same information. So trying to out time those institutional investors who have I would say not just better access to information, but they have direct influence over policy. That's speculation, right? You're basically fighting. You're going into a boxing ring with a blindfold around your around your eyes, and so I don't think that's the way to play it. It's what you're trying to do is how do I get the most tax efficient rate of return, And to do that, now I have to understand when if I have two assets and one can get me a 13% return this year and one can get me 11% forever, I want the one that's 11% forever, because if I only get 13% in the one year, I have to sell that, I have to pay tax, and then I am only left with the after-tax rate of return. And so what I want is, what's the ideal time horizon? It's kind of the Warren Buffett approach, is like, I want to hold it forever and not pay tax.
Yeah, no, that's a great answer. And anybody watching the program or being to the boot camp, that is the thing. Buy something that you want to hold, buy and hold for 100 years and never get rid of it, right? Because then you can also pass that down to the next generation, and they can also enjoy the fruits of that going forward.
Yeah, and in terms of like the Bitcoin, I mean, full disclosure, I haven't bought any new Bitcoin in 2025 at all. But I have, probably an irresponsible amount of Bitcoin as a percentage of my portfolio. So already, one that I would be nervous if it was a client, but I know my tolerance for volatility is very, very high. If yeah, Trevor, if Bitcoin goes down by 20% in a day, I'll send you a meme of something. But like, I'm not going to panic and say that'll be my action. I think the price volatility is kind of the sign of the vitality of the instrument. And so when you're on the adoption bandwagon, you should expect violent movements upwards and down, and that's the price you pay to be in potentially the next reserve asset of the world. So I haven't bought it. That doesn't mean someone shouldn't buy any. It just means it's just a reflection of my portfolio, where I saw the opportunity as, basically, in 2022. I no longer understood anybody who was recommending 0% allocation to gold or Bitcoin. It just didn't make any sense from a quantitative analysis, when you looked at the debt to GDP of all the nations around the world. When you looked at the deficits, when you looked at they had no intention of shrinking the deficits. The only pressure release valve was devaluation of the currency, and it didn't make sense that didn't have anyone had a 0% allocation at that point. It was the proverbial, wearing the mask alone in your car, like people did in COVID. That's what I saw it as, people still buying bonds at that point. The result was certain, and that turned out to be true. And then, I thought in my time, that the next buying opportunity was in 2023. It became very, very clear, after the Grayscale case on October 23rd, 2023, that the SEC was going to allow a Bitcoin ETF, and BlackRock was going to get a Bitcoin ETF. So there was just that anomaly in the market between October of 2023 and when it was launched in 2024, where I backed up the proverbial truck, and that tended to be right. So at this point, I'm overweight, and there's no reason for me personally at this point to buy anymore. But I would say people, the riskiest position you can have in Bitcoin is 100% allocation to Bitcoin, and the second riskiest position you can have in Bitcoin is 0%.
Yeah, I agree with you 100% on that. So I've got a couple more questions here. Let's see. What metrics do you apply the compound annual growth rate formula to, and then using that to educate your clients? I know you use it for population growth and the growth of the money supply. Where else?
I think we use it as for, what potentially, where you could hit your freedom number. So we look at the historical rate of return on dividend paying stocks. We look at the historical rate of return on gold, and we kind of project out there of where you could potentially hit your freedom number. Okay. And so where's that number where you have some sort of liquid financial security? Where is the point where you could recreate the median Canadian income from simply passive investments? So I like to use it there in terms of like where the growth rate is. We look at what the net worth of the top 20% is and how long it would take you to get there. Often in plans, we even take a very conservative approach and use a lower number than we think we can achieve. But I would say that's the main other one. We look at the growth in the money supply. Yes, I think that's very, very important. That's a great place to start, where almost nobody starts, where they're just evaluating investments without knowing how much money's in the system. If the money supply is expanding at 4%, the expected rate of return should be drastically different than if the money supply is increasing at 12%. And you don't get hardly anyone who's selling financial products who even talks about that, which I think is highly irresponsible. It's not like they're, I think a lot of them just don't know what they don't know. And then the other one would be, once you understand the population growth, once you understand the money supply growth, yeah, let's understand what the historical rate of return in the asset classes that you're investing in, how long it's going to take to hit your goals.
Nice. And one more question. If we price Canadian homes in gold, we're back to mid 80s prices. The currency is sick.
Yeah, like paid off houses are not the investment that people think they are. Like people think that paid off houses, like no, no, paid off houses largely underperform gold. Like maybe in a few small markets, like maybe if you're in West Vancouver on the cliff, like maybe if you're in Whistler, or maybe if you're in Bridle Path in Toronto, like outside of a few pockets, like and even in those, probably still slightly underperforming gold. Where the value of real estate is not on holding real estate that you're going to live in. It's like the value on real estate is like, okay, I have to have a certain amount of equity in the property, I have the property, but after that, I should be borrowing the money at one rate and then investing it at another rate and knowing how to do that responsibly and tax efficiently. That's the real key, right? Because that's the access to capital that the average Canadian can get to. Where they can get advantageous rates. So knowing how to use that, we call it the debt equity in your house, to actually put it into more desirable assets and how to increase your rate of return is one of the biggest opportunities that most Canadians have that they don't even know is available to them.
Yeah, and that's the big thing. Your house, when we started doing this, you're saying like your house, the mortgage is the asset. The mortgage is the asset. That's the lever that can help take you from broke to free, if you use
Yeah,
it correctly.
it's the financial. Your mortgage is a financial instrument. It's a short against the currency. It's your short, basically betting that the government's going to keep printing money to buy votes, and it's just now you got to know what to do with it. Once how do you deal with it? How do you deal with it? How do you use it efficiently, right? And most people don't. They just totally, they think completely irrationally about debt, and they think that it's somehow low risk to put 10% down and borrow 90% to buy real estate, but to have 90% loan to value on real estate and have two or three properties, but somehow having 25% loan to value on a well thought out portfolio of uncorrelated assets is highly risky. Like those two things are just wildly illogical when you understand the mechanics of them.
Yeah. Do you got time for a couple more questions from the chat?
Yeah,
All right.
yeah.
Okay.
What do they got?
Okay. So here we got Jason 1979. What are your thoughts on privacy coins?
Uh, you know, uh, on privacy coins, I don't have enough confidence as, kind of institutional grade investments at this point. That's I just don't have enough confidence in those networks that I think that they're good long-term investments. So my criteria for buying investments is like when I buy assets, it's like, is this an asset that I'm reasonably confident that I would want my family for 100 years? And I'm just not there with a Monero or something like that, right? And I'm not sure people really understand Bitcoin is completely on chain. Yes, it is on chain, but bounce it around a Lightning Network a couple of times and tell me how traceable it is. So that's probably one thing that maybe people are a little bit stuck on and they haven't tried and they haven't looked into as much. And so not there, doesn't pass my 100-year test. I'm not saying there won't ever be a privacy coin, but I think right now there is crypto, which are more speculative use case assets, and then there is Bitcoin, which I think is the de facto, as I explained to people, it's like Bitcoin is the Rolex watch. There are going to be other watches. There are going to be Apple watches that might make more money one day because they'll work faster and they'll have more features. But ultimately, the thing that makes Bitcoin successful is the fact that it's simple and secure. And so the minute you add more features, you reduce the security and they reduce the simplicity, is you reduce the value proposition of Bitcoin itself. So what that says is that, there will be use cases for other cryptocurrencies and the potential that some of them will outpace Bitcoin, but Bitcoin's the asset that I'm confident in, the likelihood that I'm going to want to hold that in my family for 100 years.
Yeah, and the other comparison is, there's gold and silver, right? Gold has been money for thousands and thousands of years, and it's been number one forever, because the number two is greatly cheaper than gold. Gold is at almost 5,000, and silver just hit, I think, $50 today. So I mean,
Yeah.
number two is never never the right choice in my book, anyways.
History has shown us, like if you go back and take the real historical perspective and look at like countries that had, focused too much on silver and not enough on gold and how they fared at like not very good, but maybe a more recent example is like, capital stampedes into the most desirable asset class. It's the reason why house prices in Vancouver and Toronto outpace Winnipeg long term. It's because capital disproportionately moves into the most desirable assets. So, housing prices in Vancouver will continue to go up at a faster rate than housing prices in Red Deer. Like that's just the likely scenario. And we see that in countless examples across history.
Yeah, agreed. I'll take one more from the chat and then we're going to sign off. Okay, so why should the economy always be in a deflationary state? In school, the opposite is taught, but where did you see the silver lining on this?
I mean, humans are naturally deflationary. We find better technologies, and we get more efficient and better technologies as we move forward. We were sold an inflationary product because if you look at the history of money and wealth, and we teach people at the boot camp, it's like, well, how did this come to creation? This mutually beneficial relationship where we were just taught that inflation was better for us, but who taught us that? We were taught it by governments who want to basically bribe us with our future earnings by printing fake money, and bankers who get a guaranteed rate of return. And so you just look at the interests of the people who are selling you that inflation is better. It's like we should want more abundance. We should demand more for the fact that humans are naturally never going to spend ever again and just hoard everything if there is no inflation. It's like, I mean, I don't know. I think, it's hard enough to get most people to save at all. And so I think if they became higher and higher wages, I mean, we saw that. You saw there was a period from, I believe, 1870 to 1920 that was, regarded as the Gilded Age in the US, where basically wages bought more and more and more, and they did so for like 50 years straight with perfectly sound and hard currency. And people didn't become savers and hoarders. That's not what happened. It's like the economy actually flourished, both in not just nominal terms, but in real terms, like where people, had more energy available to them and more food available to them and more, more transportation available to them, and it happens. So we've seen this in history. Like history actually suggests that no, that is not the case. If you have sound money, abundance actually happens. It's not that people suddenly just become hoarders.
All right. Thank you so much, Josh, for that. So, guys, thank you so much for joining us on the chat and hanging out with us late at night. We will see Josh back in the office next week, but don't forget, we still have tickets to the boot camp. We are a little over a third sold, and it's almost 5 months away. So if you haven't got your ticket yet, go ahead, go online to spurrell.ca, click the link to get the boot camp ticket, and we will see you there. Josh, any parting words for our guests?
Yeah, hit the like and subscribe. I think we're probably going to go deep next week and show you the volatility indicators that we're looking for 2026, the things that are likely to cause volatility next year in 2026. So the subscribers of this channel are going to be prepared.
Awesome. Thank you so much. Hey, thanks, guys. We'll see you next time.